So Nathan's question was, is it better to sell the investment property after we retire or after we die? As in, which is best for the kids? Which one incurs less CGT? Now, this is a really good question because CGT is really the hidden death tax. Because if you've purchased an asset after CGT came in, so after the 20th of September 1985, so let's, for example, say that you've bought in 1990, bought a home for $100,000 when homes could be bought for $100,000, and you save that, and now you're approaching retirement in 2015, and you've got and the property is now worth, let's say it's worth $500,000, and so you've got a $400,000 gain here. So that $400,000 gain could potentially, if it's discounted by $200,000. It's, the discount apply because you've had it longer than 12 months, then it's split two ways. For example, $100,000 between, two spouses. Tax on that might be around, $30,000 or so. You might be able to reduce it to around $20,000. So you've paid, you could, in this rough sort of back of an envelope scenario, pay $40,000 tax or 10% tax on a $400,000 gain. So you could actually do that then, and then put the money into the pension phase of super, for example, and not incur any further tax. Assuming that the growth is the same within the super fund as the property here, then it could potentially save a lot of money. If you lived for another, say, 30 years, and you got to 2045, and now the property is worth, say, 1.5 million, and you die, and it passes to your kids, then their tax liability is 1.4 mil, because it's $100,000 less 1.5 mil. The tax liability that somebody needs to pay, it could either be your estate or it could be the kids, but generally that's going to be a lot more than if you got the same growth rate within the superannuation accounts and that grew within the pension phase of superannuation tax-free. Then selling now, managing the gain, and investing the funds through the pension phase tax-free environment would be a better scenario. But it is assuming that you're get the same growth rate. It's a bit of an unknown, but if you're wanting to manage capital gains tax and it is feasible to manage it now, then often it is a good scenario to actually manage the capital gain, get into the tax-free environment. Capital gains tax is the hidden death tax.